Welcome back to We Are Cosmic, the channel where we break down finance, crypto, and global money shifts in a way that actually makes sense. If you're someone who wants to understand where the money is moving before the headlines catch up, you're in the right place. Today's video is extremely important because something just happened in the United States that could quietly reshape the entire crypto market over the next few years. Let me start with this question. What if I told you that the biggest obstacle holding banks back from fully entering crypto is finally being removed? Not hype, not rumors, actual legislation. Because the US Senate has now officially unveiled a crypto market structure draft bill, and this is one of those moments that doesn't look dramatic on the surface but has massive long-term consequences. This bill is being presented directly before the US Senate, and its main goal is to create a clear regulatory system for digital assets. In simple terms, it explains who regulates what, how digital commodities can be offered and sold, and what role institutions like the SEC, the CFTC, and even the Federal Reserve are allowed to play. And the key word here is clarity. Markets don't move on emotions alone. They move on certainty. For years, banks have been watching crypto from the sidelines. Not because they didn't want in, but because the rules were unclear. They couldn't custody assets freely. They couldn't offer products confidently. They couldn't fully participate without legal risk. This bill changes that dynamic. It is designed to unlock what banks have been waiting for, the green light to engage with crypto at scale. And here's what makes this even more interesting. This bill is not some distant idea. It's already making progress, and it is expected to be fully released within this year. That timing matters because it's happening alongside some very important macro developments. Just today, US inflation data was released. Inflation remains at 2.7%, but CPI inflation actually dropped to 2.6%. That tells us something critical. Despite tariffs being in place and despite economic pressure, inflation is still cooling. That gives policymakers more flexibility, and it shifts expectations across financial markets. At the same time, we're seeing digital assets respond positively. XRP, for example, has been showing strength, moving around the 210 level with noticeable momentum. Yes, there have been short-term ups and downs, but the bigger picture is what matters here. Strength during uncertainty is a signal experienced investors pay attention to. Now, add another layer to this situation. Political pressure is rising again, especially around the Federal Reserve. Former President Donald Trump has openly increased pressure on Jerome Powell, calling him out publicly and pushing hard for interest rate cuts. Whether you agree with that stance or not, it doesn't change one thing. The pressure is real, and markets react to pressure. Lower interest rates historically favor risk assets. They increase liquidity. They push capital out of safe havens and into growth opportunities, and crypto has always been extremely sensitive to these shifts. So when you step back and connect the dots, you start to see why this moment matters. Regulatory clarity is advancing. Inflation is cooling. Political pressure on monetary policy is rising. Institutions are watching closely, and crypto is no longer sitting outside the financial system. It's being pulled inside. All right, now that we've set the stage with the big picture, let's dive deeper into the crypto market structure bill itself. This is where things get really interesting because the devil, or in this case the opportunity, is in the details. The bill is essentially designed to provide regulatory clarity, something the crypto space has been desperately waiting for. For years, investors, institutions, and even banks have been unsure about what counts as a security, what counts as a commodity, and who exactly has jurisdiction over which assets. That uncertainty has kept trillions of dollars on the sidelines. With this bill, the rules are being written in stone, at least from the US government's perspective. So, how does it actually work? First, it clearly defines digital assets. Not just broad, vague terms. It specifies what a digital asset is, what constitutes a digital commodity, and what falls under the category of a security. This distinction is huge because it tells the market who regulates what. Under this draft, the Commodity Futures Trading Commission, CFTC, is responsible for digital commodities. That includes assets like Bitcoin and, importantly, XRP if it is classified similarly. These are treated like commodities, meaning banks and institutions can hold, trade, and custody them without excessive restrictions. The Securities and Exchange Commission, SEC, handles security-like digital assets. These are the tokens that behave more like traditional stocks with ownership rights, dividends, or promises of profits. Why does this matter? Well, if you're an investor or part of an institution, you need to know the risk profile of an asset. Regulatory clarity reduces uncertainty, encourages adoption, and allows bigger players to participate without fearing legal consequences. This is one of the main reasons XRP could benefit massively from this legislation. XRP already has a strong case for being a commodity-like asset thanks to previous court rulings. With this bill, that clarity could become official, opening doors for ETFs, cross-border banking applications, and institutional trading. Another important provision in the bill is how banks can interact with crypto. Right now, banks are limited in how they can custody digital assets or offer them to clients. They can't fully engage with the crypto ecosystem without risking compliance issues. This bill removes some of those barriers, meaning banks could offer crypto custody for clients, include digital assets in investment products, facilitate cross-border payments using blockchain solutions. From a practical standpoint, this is huge. Think about it. Banks control the majority of capital flows in the world. If they are allowed to legally participate in crypto markets, it's like opening a floodgate for liquidity, legitimacy, and mainstream adoption. That's why this bill isn't just regulatory paperwork, it's a catalyst for institutional money to enter crypto on a massive scale. Now, some purists in the crypto space might worry about centralization. They might say, banks entering the market will ruin decentralization. Here's the thing. Decentralization and institutional adoption aren't mutually exclusive. If you want, you can still hold XRP on your personal wallet. You don't need a bank. But for millions of users who want convenience, security, and regulatory compliance, banks offering crypto solutions is a massive step forward. It doesn't replace decentralized ownership, it complements it. This is also important for traders and investors like us. Regulatory clarity often reduces volatility caused by fear of legal crackdowns. Once institutional players understand exactly what they can and cannot do, markets become more predictable. And that creates a safer environment for growth, both for retail and institutional investors. Finally, the bill also touches on disclosure requirements. For assets like XRP, this means lighter reporting rules compared to traditional securities, which makes them more attractive for ETFs and institutional adoption. Basically, this bill is building a bridge between traditional finance and digital assets, and XRP is positioned right at the intersection of that bridge. Now that we've broken down the regulatory framework and what it means for crypto adoption, let's zoom in on something every trader and investor wants to know, what this means for XRP itself. Because at the end of the day, understanding the law is important, but understanding how the market reacts is where you actually make moves. First, let's talk about the current XRP price levels. At the time of this update, XRP is hovering around $210. And while it has had its ups and downs over the past few days, there are some very important signals in the charts that point toward potential bullish momentum. We're seeing higher highs and higher lows, which is one of the clearest indicators that a bearish trend may be ending. If you've been following crypto markets, you know how rare it is to see this kind of strength after months of sideways or downward pressure. Now, why is XRP moving in this way? A big part of it is regulatory optimism. Investors and institutions are paying close attention to this crypto market structure bill. Once clarity is officially provided, particularly if XRP is treated as a commodity, it will open the door for ETFs and institutional products, meaning XRP could be included in regulated investment vehicles, bank custody, and trading, enabling banks to hold XRP for their clients, which could dramatically increase demand. Cross-border adoption, XRP's use case as a fast, low-cost bridge currency becomes even more appealing for financial institutions. All these factors combined create a bullish narrative that traders are starting to price in. And when markets start anticipating institutional involvement, the short-term volatility often shifts upward as retail traders and smaller investors start to buy in. Looking at the technical side, we also need to consider resistance and support levels. XRP has a top resistance line around 211-212 os, which has historically been a barrier during past rallies. When an asset approaches its resistance, it's normal to see minor pullbacks or consolidation. But what's encouraging here is that XRP is approaching this level with significant momentum, meaning if it breaks through, the next target could be $230-241, which were previous highs. Breaking these levels would signal a potential re-entry into a full bullish trend. For traders, this is a crucial moment. The combination of regulatory clarity and technical momentum sets up what could be a high probability trade window. Those who understand the narrative, why banks want in, why ETFs are coming, and why institutions are paying attention, can position themselves early, potentially before the broader market catches on. Now let's also discuss risk management, because even in a bullish scenario, crypto markets can be unpredictable. While XRP shows strong signs of recovery, it's important to recognize that pullbacks are natural. Setting stop losses, understanding position sizing, and not over-leveraging are all key. The goal here isn't just to catch a move, but to protect your capital while maximizing potential upside. Another point worth noting is market psychology. When news like this hits, regulatory clarity combined with political shifts affecting monetary policy, it often causes waves of FOMO, fear of missing out. Retail investors start buying in anticipation of institutional involvement, which further strengthens the upward price movement. That's why timing and understanding the underlying fundamentals is just as important as reading the charts. Finally, for anyone following XRP specifically, this is also a reminder of long-term positioning. Even if short-term swings happen, the bigger trend is toward adoption, integration with banks, and broader legitimacy in the United States. Those who can hold through volatility, understand the regulatory backdrop, and align with market trends are likely to see the most significant benefits. Now that we've covered regulatory clarity and XRP's price action, it's time to zoom out and look at the bigger picture. How banks and institutional players are about to reshape the crypto market, and why this could be a game changer for digital assets like XRP, Bitcoin, and Ethereum. One of the most important points of the crypto market structure bill is that it removes barriers for banks to participate in crypto. Traditionally, banks have been extremely cautious. They can't just hold client assets in crypto without being fully confident in the legal framework. They can't offer digital asset custody or investment products because the rules have been murky. But with this bill, all of that changes. Banks now have regulatory clarity, meaning they can custody digital assets like XRP for clients, offer ETFs and other investment vehicles, facilitate cross-border transactions using blockchain technology, trade digital assets on behalf of institutional clients. This is massive because banks control the flow of trillions of dollars globally. Once they start holding and trading crypto openly, it adds legitimacy, liquidity, and stability to the market. Think about it. Exchanges and retail traders have been the main drivers of crypto growth so far, but banks entering the space means major capital flows, institutional-grade infrastructure, and a broader audience willing to participate. Why does this matter specifically for XRP? XRP is designed for fast, low-cost cross-border payments, which makes it extremely attractive for banks. Unlike Bitcoin, which is primarily a store of value, XRP's utility is directly aligned with what financial institutions want to achieve, moving money efficiently, quickly, and at a fraction of traditional costs. If banks can now legally hold and use XRP, the potential adoption curve accelerates. Let's also talk about ETFs and institutional products. With regulatory clarity, XRP could be included in ETFs as early as 2026. This means large investors who traditionally don't touch crypto can gain exposure to XRP without ever buying it directly. ETFs bring massive new demand, and the market often reacts strongly to these announcements because they unlock trillions of dollars of potential capital. Another critical aspect is custody solutions. Banks entering crypto means that retail and institutional investors will have secure, insured ways to hold digital assets. This addresses one of the biggest fears in crypto, losing access to your assets. When banks and large financial institutions start offering custody for XRP, it provides confidence for new investors who might otherwise be hesitant to participate. Now, some might argue this increases centralization. And yes, having banks involved means a centralized entity is part of the system. But here's the key. Decentralization and institutional adoption can coexist. Individuals who want full control can still hold XRP in their own wallets, but those who prefer convenience and security have new options. This dual approach expands adoption without forcing anyone into a particular model. The market psychology here is important too. Institutional involvement signals legitimacy. Once big players like banks start holding XRP, retail traders perceive it as safer. This often creates upward momentum as retail demand meets institutional inflows, a classic self-reinforcing cycle that has happened in other asset classes like gold, equities, and even Bitcoin in the past. Finally, the broader implication is that crypto is slowly becoming part of the financial infrastructure. It's no longer just an alternative investment or a speculative asset. With banks able to integrate XRP into cross-border payments, trading, and custody, digital assets are becoming a functional part of global finance, not just a digital novelty. And for traders and investors watching closely, understanding this shift gives you an edge because the institutions entering today are the market makers of tomorrow. Now that we've discussed banks and institutional adoption, it's time to look at the macro picture because crypto doesn't exist in a vacuum. Interest rates, inflation, and political pressure all directly impact how digital assets behave. And right now, we are seeing some very interesting dynamics at play. First, let's talk about interest rates and the Federal Reserve. Jerome Powell, the current Fed chair, is under immense scrutiny. Former President Donald Trump has publicly criticized him, saying he's either incompetent or crooked and pressuring him to cut interest rates. Whether you agree or not, the reality is that political pressure can influence market expectations. If the Fed lowers interest rates sooner than expected, it creates more liquidity in the system. Historically, lower rates push investors toward risk assets, including crypto. At the same time, inflation data is showing progress. U.S. inflation has cooled to around 2.7%, down from previous levels. This is a critical point because inflation trends affect the Fed's decisions. Low and stable inflation gives the Fed flexibility to adjust rates in a way that can support risk assets. For crypto, this is positive because it means there is a higher probability of supportive monetary policy without aggressive tightening. Now combine that with the crypto market structure bill we discussed earlier. The timing is crucial. Banks are waiting for clarity, macro conditions are favorable, and political pressure is pushing monetary policy in a potentially bullish direction. When all three align, the market tends to react faster and stronger than during normal periods. For XRP specifically, this macro environment matters because it's already showing strength in price action. With the top resistance level around $211 and previous highs near $241, any positive institutional adoption news combined with macro tailwinds could accelerate upward movement. Traders often see this as a high confluence setup, where multiple factors push the price in the same direction. Another angle to consider is cross-market correlation. Crypto often reacts not just to crypto news, but also to broader financial markets. For example, if the US dollar weakens due to interest rate cuts, crypto can benefit as investors look for alternative stores of value. Similarly, lower yields in traditional markets make high-risk, high-reward assets like XRP more attractive. Essentially, the macro environment sets the stage for capital to flow into crypto. Political factors also play a role in market sentiment. Trump's statements about the Fed and inflation are creating uncertainty for traditional investors, which often pushes them toward alternative assets. Crypto benefits here because it's increasingly seen as a non-traditional hedge. XRP, with its established network and utility in cross-border payments, is uniquely positioned to capture both speculative interest and real-world adoption. It's also worth noting that investor psychology is heavily influenced by these macro signals. When regulatory clarity, low inflation, and political pressure align, we often see increased buying momentum. Not just from retail, but also from institutions who are now confident enough to enter. This creates a feedback loop. As demand rises, prices go up, which in turn attracts more investors. Finally, understanding this macro landscape allows traders and investors to make smarter decisions. It's not just about chart patterns or short-term volatility, it's about knowing why the market moves. Regulatory clarity gives the legal framework, banks provide liquidity, and macro trends determine timing and intensity. Together, they form a perfect storm for potential market acceleration in XRP and other major digital assets. Now that we've covered the regulatory framework, institutional adoption, price action, and macro influences, it's time to tie everything together and talk about what you can do as a trader or investor. This is where all the information we've discussed becomes actionable. First, let's discuss positioning for XRP. Regulatory clarity is a massive catalyst. With banks and institutions soon able to legally hold and trade XRP, the demand curve is likely to shift upward. For retail investors, this means that timing your entry is critical. The top resistance we discussed around $211, $212 is a key level. If XRP breaks this, it could signal a move toward $230, $241, and potentially higher if institutional adoption accelerates. Traders who can identify these breakout points early are in the best position to benefit. One simple strategy is to monitor key technical levels while keeping an eye on macro and regulatory news. Crypto doesn't exist in isolation. Every tweet, policy change, or political statement can impact market sentiment. By combining technical analysis with fundamental insights like the crypto market structure bill, you give yourself an edge over traders who focus on charts alone. Another important approach is diversification within crypto. While XRP shows strong potential due to its banking and utility-focused use case, it's wise to balance your portfolio with assets like Bitcoin and Ethereum, which also benefit from regulatory clarity and institutional interest. Diversification reduces risk and allows you to capture gains across different segments of the market. Let's talk about risk management, which cannot be overstated. Even with bullish catalysts, crypto markets are volatile. Use stop-loss orders to protect capital and never risk more than you're willing to lose on a single position. Remember, the goal isn't just chasing short-term gains. It's about building consistent, sustainable growth. For long-term investors, this period could be historic. XRP is now positioned at the intersection of regulatory clarity, institutional adoption, and macro tailwinds. Holding XRP with a long-term mindset could allow you to benefit from mass adoption trends, ETF launches, and banking integration. However, it's also important to stay informed. Market conditions can shift rapidly, and understanding updates from the SEC, CFTC, and macroeconomic data is essential. Practical tools to help you include trading communities, alerts, and research platforms. Being in a space where you can quickly access news, trade signals, and expert analysis helps you react faster than the average investor, especially in a market as fast-moving as crypto. Finally, a key takeaway for everyone watching: you have choices. You can hold XRP in a personal wallet, participate through exchanges, or leverage new bank-based custody solutions as they become available. Centralized or decentralized, short-term or long-term. The important part is making intentional decisions based on knowledge, not hype. Regulatory clarity is coming, and it removes major barriers for banks and institutions. XRP benefits uniquely from this clarity due to its commodity-like status and utility in cross-border payments. Price action shows strength with clear resistance and breakout levels signaling potential gains. Institutional adoption and bank custody can bring massive liquidity and legitimacy to the market. Macro trends and political pressure play a critical role in shaping market sentiment and timing. Actionable strategies include timing entries, diversification, risk management, and staying informed. In short, we are at a pivotal moment for XRP and the crypto space in general. Those who understand the narrative, follow the data, and act strategically have the potential to benefit enormously. So remember, whether you're here for short-term trades or long-term positioning, knowledge is your greatest tool. Keep analyzing, stay informed, and make your moves with confidence. Thanks for watching We Are Cosmic. If you found this breakdown valuable, hit the like button, subscribe, and comment your thoughts below. I want to know how you're planning to position yourself for this next crypto wave. And don't forget, trading responsibly and staying educated is the key to navigating these exciting times.